So first of all, good morning, everyone. Thank you so much for attending this webinar. My name is Jasleen. I also work with KMB Law, and I'm very pleased to introduce our guest speaker for today, which is Ian Wick. Ian is a partner here at KMB Law and is engaged in a broad corporate commercial practice. His practice focuses on the areas of mergers and acquisitions, corporate reorganizations, private equity, shareholder and owner relationship agreements. So in today's webinar specifically, Ian is going to discuss the common mistakes in merger and acquisition transactions, as well as his top 5 tips for both sides of the transaction fence. The webinar will conclude with a Q&A session. So if you have any questions just along the way, please feel free to just type them in the chat and I can read them out to Ian at the end. This session will also be recorded and the recording will be available on the MBOT site in the next coming weeks. So yeah, I will just pass it over to you now, Ian.
Yeah, thanks everybody for taking time to listen. I know we all have busy lives. I appreciate that we want to spend a little time listening to the thoughts that I have with regards to transactions. As Jasleen said, about half of what I do on an annual basis would be transaction based, and I've been doing that for a little less than 30 years, which I guess means I've got a lot of scars, provide lots of experience. The webinar today is really to talk a little bit about observations that I've had a chance to have to make over that time period about mistakes, about common areas of concern or issues in transactions. And it's not really, in many ways, it's not really a legal seminar. It's not focused on particular legal issues as much as it is really anecdotes, observations over that time that relate more to approach and business tactics than anything else. And so I'd like to start with a little bit of a discussion about sort of process and how people like me see the process. And so the first point is that a transaction really is the culmination of a journey. And I'm involved in the transaction at the end, of course, but sometimes involved in the journey that gets there. Certainly for the seller, it can be a journey that's pretty lengthy. Even for a purchaser, it's not a short period of time. But in particular, from the perspective of a seller, this can be a very long time frame. And a lot of times people don't realize just how long. So as an example, when I'm thinking about a timeline for a transaction or for preparing for a transaction, as an example, usually we think of it in this fashion, which is a timeline of 2 to 5 years to prepare and plan for a transaction. That's a pretty long period of time. But in addition, it's a 6 to 12 month period for the transaction itself, as far as going to market, making sure that you are able to put your promotional package out, your CIM out, and get people to be interested, and then possibly get letters of intent, and then through to a sale. Then finally, you've got the payment period, and the payment period post-closing could be anywhere from 1 to 5 years, and a 5-year payment period is not uncommon. So when you put all that together, what that means is that someone could look for a journey that's even longer than a decade. And many parts of this are unavoidable. Let's take the planning part. And sorry, I see that there's a lot of people talking about echo. I'm not sure, Jasleen, what, if anything, we can do about that, but I will leave that up to you. So on the timeline for tax planning, some of you probably know that if you want to plan around a share purchase type of transaction, which many vendors want to do to maximize their tax planning and tax deferral, and use multiple capital gains exemptions, all very common things to do to reduce tax payments. Well, that planning has to be completed at least 2 years in advance, because anyone who's selling shares to be eligible to use the capital gains exemption has to have held them for 2 years. But in addition to that, the shares have to have increased in value. What does that mean? It means that you not only have to complete the planning, you have to have the business grow and grow enough to make the tax savings be useful. And that can be a 2 to 5 year period. So again, planning just takes you 2 to 5 years to get there. You have a transaction period that is probably somewhere in the ballpark of a year long, and that's not including your post-closing obligations, non-competes that often last for 5 years, and payment terms that can last up to 5 as well. So it's a long period of time for a seller. It's a long period of time to prepare to do it right. And if you're intending to sell, you need to prepare basically from the time that you start to think that way, when you turn your mind to it. Many people have sales that are driven by events, and those can come up and be unanticipated. But if you're planning, if you can see it in the future that you intend to transition out of business, then that's the timeline you need to work with. That's the timeline you need to implement, which really means you probably need to start planning immediately. I listened to a radio show a few months ago and heard someone talking about professional athletes in retirement. And I think it was a retired goalie who made the comment. He said, as soon as you start thinking about retirement, it's time to retire, because you're going to change. You're going to change that attitude or approach. And that's the type of approach you need to take as a vendor. You need to start to prepare. So that's my first point. You can never prepare too early. With regards to purchasers, the timeline is usually much shorter. It's usually around a year for them to complete an actual purchase. So for them, the timeline is tighter, but they still have the post-closing obligations. Again, they can expect to be dealing with a vendor for a minimum of a year or 2 years post-closing. Plus, they probably have payment obligations to continue, and they're also ensuring that the non-compete gets honored. So again, even for a purchaser, it's not uncommon for their time frame for total completion of the transaction, all those post-closing obligations, it's anywhere from 1 to 6 years. Again, lengthy period of time. Transactions take time. The next point I'd make is sort of an observation, has to do with letters of intent, and whether you've sold businesses or haven't sold businesses. It's an interesting discussion around letters of intent, because in a business transaction, they often are the very first document that outlines the transaction. And there's a rule of thumb, very simple in transactions, and that is letters of intent. Purchasers like skinny ones, and vendors should like long ones. And people always say, well, why? What is the difference? And sorry, guys, I think we're here trying to work on the echo issue here. So hopefully we'll be able to resolve it soon. But on the letter of intent side, a purchaser really is only looking for one thing. And that one thing is exclusivity. They want a commitment from the seller for a specific period of time, usually as long as they can negotiate. That means the seller will not deal with or even look at or entertain offers, discussions with anyone else other than them. That's all the purchaser is really looking for. So you have one goal if you're a purchaser, and you want to attain that goal. One of the easiest ways to do so, and sorry, we are trying to work on the sound side. I don't know if we're making any progress or not. But since you only have one goal as a purchaser, what do? You try to exclude everything else from a letter of intent that might be contentious.
Okay, all right. And sounds like we have solved this problem. Okay, so LOIs. I mentioned as the second point that people should take away. Really simple. Purchasers like short ones. They only want one thing, and that is exclusivity. And they don't want anything to get in the way of you agreeing to exclusivity. Sellers should like long ones, and many sellers don't. They agree to a short form. And when I talk to them, because inevitably they come to the lawyer after they've signed the LOI, and we have this discussion, the answer is always the same. Well, I didn't want to jeopardize the deal by getting into the weeds and discussing transaction terms. And my short answer to that is that this process is different than marriage. You know, if you're married, you're getting married, you date, you have the ceremony, and then you have the honeymoon. Transactions are not like that. The way it works is you meet, you date a little bit, start to get to know this purchaser, they sign an NDA, then you sign a letter of intent. That's the honeymoon. The honeymoon comes before the signing of the letter of intent, because that's what they want you to sign. Therefore, since that's the honeymoon period, that's the time to ask and deal, if you're the seller, with difficult questions. That's the time to really deal with issues around purchase price, payment terms, most definitely indemnity language and claims, because a purchaser will want to defer that all to the later time. Because after the LOI is signed, they start due diligence. And then really what they do as a purchaser is they examine your business closely and they find reasons why their expectations and your expectations as a seller are not accurate. So they really attack or chip away at what's been promised previously. Of course, if nothing's been promised in the LOI, then they don't have to worry about chipping. Okay. So generally speaking, you get those two issues. Another common issue that I run into around letters of intent is with brokers. Brokers can present a challenge. A good broker is essential for your business if you're looking to sell that way, because they can take you to market much more effectively. They can find a lot of buyers. But many times brokers will say, do not show the letter of intent to your lawyer. And they will say, don't do that because it will jeopardize the deal. They always find holes, etc. And not all brokers do this, but I have run to it more than one occasion. And people need to remember, if you're a seller, as an example, brokers get paid on commission usually, and they get paid on commission if a deal closes. Most lawyers don't. They get paid one way or the other, deal or no deal. So it means that the interests are different. There's a conflict with a broker wanting to close a transaction and therefore needing to be a little careful around the terms. Whereas, of course, the lawyer is looking and saying, well, this doesn't make sense. All right. My general rule of thumb for people around letters of intent, if you're a seller, is you want to get everything covered in there because it's the honeymoon. This is when the purchaser will agree to things to get the exclusivity period. So discuss it. On the other hand, if you're a purchaser, what do you want? And if I was advising a purchaser, absolutely. Let's keep it bare bones, as skinny as possible, get the lengthiest exclusivity period we can. And after that, beat up the seller on terms. What else would I say? The next one, just a general comment found in a number of transactions, and that is that the parties need to remember nothing's personal, or at least it very rarely is. And sellers are more vulnerable to this. They're more sensitive than purchasers generally are. This comes up usually with the seller being upset, be blunt, being offended. They might be offended because of the purchaser's evaluation of family employees and whether or not they're essential and whether or not they should be kept. They may be offended by the purchaser's view of the way the business has been managed or operated. They may be offended by what the purchaser intends to do with the business and has indicated they want to do with the business immediately after closing, such as changing the name. They may be offended by the purchaser's comments around the reporting systems and financial information and data. They may also be upset by how the purchaser views their profitability and the repeatability of their profit margins. This can all be very personal because for the seller, this is their business and many times it's their baby. The purchaser, of course, that's not true, very impersonal. This is not tied to them and also has an incentive to point out these weaknesses because these weaknesses, these issues, they have to do with price, they have to do with payment terms, they have to do with liabilities that are taken on in the business. And the purchaser wants to minimize all of that. So again, it's important for the parties, in particular sellers, to remember this is usually not personal and not to take it personally. Number 4 is an interesting one. And number 4 is trust your gut. You know, if you're a seller or a purchaser, you may like the business, but if you don't trust or like the people you're dealing with, that is very often there is good reason for that. And that doesn't mean that they are a bad person, but it might mean they're the wrong fit for you. And the problem there is that there is no such thing with a seller, if you're the purchaser, or a purchaser if you're seller, either way. There's no such thing as a relationship that ends on the closing of the transaction. That is not the way these things work. You will need each other post-closing. You will need to be able to trust each other post-closing. And generally speaking, it doesn't matter how good your paperwork is. And I say this as a guy who's drafted lots of paperwork and dealt with lots of it. It doesn't matter how good that paperwork is. If the other person is untrustworthy, or if they are antagonistic towards you, then there will be problems, and there will be problems that will not be covered by the paperwork. If you're a purchaser, you want to make sure that seller is going to assist you in the way they promise post-closing, and you rely on that, and probably rely not just on them fulfilling their consulting agreement obligations of coming in, 3 hours a day, 5 days a week for the next 6 months. No, you need them to actually do things that are useful and to help you transition knowledge in the business. If you're the seller, you're probably having to trust that purchaser, including some post-closing payments, as far as being able to depend on them and feel that they're honorable people. Either way, what I have found over the years, generally speaking, is most of my clients, their guts were good. If they had problems with the person, they anticipated they were going to have them well before closing. And the reverse is true as well. Most of my clients who have said my gut reaction is, I think this is a good person, Ian. I think this is going to be fine. You know what? Most of those reactions were accurate as well. So I can't emphasize enough. Trust your gut. And I know that may sound risky, Ian. If I don't think I can trust this person, I may not get another deal. You may not, but you might avoid a pretty big mess. And you don't know you won't get another deal until you try. The last, fifth point I have, sort of general comments. Parties need to plan for the morning after, right? After you close. If you're the purchaser, what is your plan for day one? What is the plan for you introducing yourself to not just the employees, but to suppliers, to customers? What is your plan for handling those relationships? How are you going to do that? What is your plan for sort of retaining key people and in promoting and incenting key people? What's your plan? And what are you going to do as far as not just day one, but how about the end of the first month and then the end of the first year? What is your plan for this business going forward? Because the closing is just the beginning of your journey with the business, not the end. The same is very true for sellers. Immediately post-closing, that seller's life is going to change. The principal's life is definitely going to change. And the question is, what are you going to do day one? Well, day one's probably going to be pretty busy. But what about day 100? What about day 500? How adjusted are you to the concept that this business will no longer be in your life and it will no longer be part of your identity? These are important things for both sides to think about and make sure that they have planned for. And now I come to my last sort of general comment, which sounds very self-serving, but my last one is spend the money. Spend the money. And what am I talking about? I'm talking about spend money on the professionals and spend it at the beginning. Now, of course, when I say professionals, I mean a guy like me. I mean a lawyer, absolutely. I also mean spend it on your accountants. Both sides, purchaser and seller. Spend it and spend it at the beginning. Spend it on the planning. Because if you have a poor plan, it's hard to fix that plan on short notice. Very difficult. But if you put together a good plan at the beginning, then all we're talking about is execution. And execution has its own challenges, but it's much easier to follow a good map and get where you want to go than it is to get halfway through the journey and realize the map's no good. So take the time. If you're a seller, deal with the tax planning and the structuring that you need to minimize your tax burden, to maximize the advantages you have, to minimize liability post-closing. Do all those good things. If you have, as a purchaser, do your structuring for your plan as well. Understand how your financing is going to work and how that plays into your structure. Take that time up front. Don't try and figure it out. In particular, don't try and figure it out after you've gotten your commitment letter. Many deals, we see, we have the purchaser come to us with a letter of intent and a commitment letter. And once we sit down and look at that, if we're lucky and we have the commitment letter at that time, we can show that the two don't actually match up. What does that mean? It means you got to go back and either get a new commitment letter or get an amendment. And what does that mean? It means it goes through credit and risk again, which is time that we can't change because that's how the banks work. So again, plan it out ahead of time, figure these things out. And if you're a seller, whatever else you do, Make sure you engage the professionals early, before you sign the letter of intent. Understand what your key deal terms are. Get that planned out and understood while you're still negotiating the letter of intent. Now, those are some general comments, again, just coming from sort of things I've seen over the years. What about specific tips? What about specific issues? I'd like to deal with the sales side first, I think. And my first tip or mistake that is very common for sellers is systems. And when I say systems in particular, I'm talking about your accounting systems. It is essential in the process to be able to produce information that meets these three criteria. It must be precise, it must be complete, and it must be current. And if your systems can't do those three things to produce precise, complete, and current information to give to a purchaser, then the answer is you need to improve your systems. And listen, that I'm a lawyer. I don't make any money off of you as a seller improving your systems, but I can tell you it's essential in a transaction. And the reason it is because it establishes trust between the purchaser and the seller. The seller tells the purchaser, this is the way this business is. This is it. This is how it does. Now the seller has to back that up with its information. If it cannot back it up with that information, if that information is wrong, if it needs to be corrected multiple times, if it is exceptionally slow, then that creates a problem for the purchaser. Can they trust the seller? You know, that's how it goes. Can I trust the information? If I'm not sure I can trust the information, how can I trust the provider of the information? And remember, there's somebody behind a purchaser, usually at least one somebody, and sometimes multiple somebodies, and that's financing. So the purchaser not only has to feel very comfortable with the information they're given, they have to persuade their financiers that the information is reliable as well. If you can't do that, it creates all kinds of problems in trying to sell your business and justify price. So systems are absolutely important. And one thing I like to say to people, you know, when I started this type of business, the nature of many purchasers was different. Many times purchasers of a business were either competitors or related companies or symbiotic companies, okay, in the same industry. Very common. And so they were either buying to take out a competitor or to add to their line or to cover more of a part of the market. So in other words, they were very familiar with the industry and many times very familiar with the niche that the seller was in. That's no longer true. You know, our practice, we have a ton of people that are selling to private equity. And of course, those are people that, to be honest, many times know very little about your industry when they walk in the door. In addition, we're doing a lot of transactions for people who have been longtime senior employees, and perhaps this is a result of the pandemic, but they are buying businesses. They're moving from senior management positions. I want to own or run my own business. Sometimes those are people buying in a related field. They know, they understand the field. But we've also seen a lot of transactions lately where they don't. What they're looking for is something they think is interesting, something they think that has opportunity, may not be related. Well, these people, they don't have any knowledge of you as a seller, of the industry or how the business works. So if the answer is that the way you explain your inventory and the fact that you carry 2 years worth of inventory because it just made sense, and listen, you know you'll be able to sell it one day. That might make a lot of sense to another person that's been in the industry for 10 years. It makes none to a third-party purchaser. So systems, absolutely important. Make sure that if you can't use your accounting information to explain the business well to a third party in 5 minutes, then you may need to talk about upgrading your systems and talk to your accountants about that. The next one on the seller side, the business or the goodwill of the business is too tied to the principal. This is a challenging one because people are trying to sell businesses usually, not always, but usually based on EBITDA. And from a purchaser's perspective, what they want to be able to see out of the EBITDA is they want to be able to see repeatability of the revenue and therefore repeatability of the profit in the future. And if too many of the relationships are still fundamentally tied to the principal, the concern is that when the principal leaves or retires, that those relationships will erode or just disappear. There's gonna be attrition. Well, that goes right to purchase price. How much risk is there to the repeatability of that EBITDA? Now, for your typical seller, this is a challenging issue because you're saying, Ian, to mitigate risk for a purchaser and therefore to be able to defend my purchase price, I have to introduce risk now. I have to transition these relationships to somebody else in my business. What if they leave? And the short answer is yes, you're right. There is a conflict there between taking on more risk in the business now in order to reduce the risk for a purchaser and therefore drive up purchase price. But that is what you need to do if you want to maximize purchase price. You're going to need to find the people you can trust, which you may have to compensate and incent accordingly to transition those relationships away from you, because people will not pay for that type of risk. What's my third one? And my third one for sellers could have been number one. Unrealistic expectations as far as purchase price. Sellers, it's hard to be objective about a business because if you've been running it for a long time, it's been your baby for a long time, you're not objective any more about a business than you are about your kids. So what do you need to do? Well, probably the only thing you can do is to get some third-party valuations, even if that's just from your own existing accounting firm, something to show what they think the business is worth objectively. And this actually is useful in two ways. First of all, if you're a seller, it can help you reach a realistic valuation, an objective valuation. It's useful for the purchaser as well to be able to say, look, this is why I'm only paying X, but it's also useful as something else. You know, I often tell people, if you're thinking about retirement and your business is part of the tools that you have to reach retirement, you know, this is what you're going to use to generate the income you want in the future in retirement, then why don't you get a valuation done? And don't get one by your accountants. Get a proper valuation, a full-blown valuation done. And again, we don't do that. It's no money in my pocket. So why am I suggesting it? I'll tell you why. Because if you get a proper valuation done, that valuation comes not only with a number, it comes with an explanation. And it points out the weaknesses, problems, whether they're specific to your business, industry-wide, whatever it may be, that reduce the value. And then what you do is you take that valuation, you take that explanation, and you use it as a roadmap to get a higher valuation in the future. This goes back to the idea of planning. If you want to sell your business down the road, get a valuation done now. You say, Ian, I don't want to exit for 5 years. Don't exit for 5 years, but get a valuation done now, see what your weaknesses are, and then take the next 5 years to fix them. So that by the time you sell, you're talking about selling something that is very saleable, very desirable. So again, unrealistic expectations, they have to be dealt with. Usually the only way to do it is with valuation. If you're a seller, you might as well take advantage of that by using it and getting one done very early to be able to fix the problems and drive a value. Number four, and this is another one that's common with sellers. You get in discussions with a purchaser and there are problems in your business. You know there is, whether it's litigation, whether it's a competitor that's growing, whether it's a recent defection from your organization, whatever it may be. You have weaknesses or problems that need to be discussed or addressed. And generally speaking, sellers try to defer the bad news because they're worried that it will make the deal go away. Listen, the deal may go away, and that's possible. But generally, my experience is you want to deal with problems immediately. If there's a problem, and now that maybe not as on the first day you meet the purchaser, but if they're interested, then you start down that process. Then when you have got an NDA signed and you're in discussions, talk about these issues. First of all, we've talked earlier about the honeymoon period. It's always easier to disclose these issues and get them addressed prior to execution of an LOI. If they get disclosed after an LOI, it will reduce your purchase price, given. You did disclosed up front, sometimes you'll find that the purchaser at that stage is so eager to just to get a commitment that they'll be willing to negotiate on that point. There may not be a reduction, so it's worth your while. In addition, it goes back to trust. If you're a purchaser and a seller comes to you pretty late in the process and fesses up, or worse, you're doing your due diligence and you discover the problem and have to confront the seller with it, and that's when they admit, well, now you've got a trust issue. You know, if they didn't tell you something like this. What else have they not told you? Again, the process is about trust. We want to try and build trust, not put things in that attack it. What about number 5? For sellers, again, something I can't emphasize enough. You know, most sellers, when they sell their business, it's a one-time thing. They haven't sold a business before. They've been in business for a long time, but never sold a business. They've run their business for a long time, but never sold it. And it's a very disruptive process, lengthy, exhausting. Due diligence can be brutal. And what I always try to emphasize with the seller is, remember, you have to run through the finish line, okay? You can see a deal coming. Don't slow down on the business and don't get distracted from the business. The first issue is always the business for a number of reasons. One is there is no guarantee a transaction will close. So always carry on your business as if you're not selling it. You have to devote just as much time to it, and you have to make decisions as if it's not for sale, because it may not sell. That's number 1. Number 2 is, if you neglect the business to try and get the deal done, remember, the purchaser is seeing this. They can see the results. If your business, instead of going like this, starts to go like this, or even erode slightly between, let's say, the letter of intent and closing, which can often be a 60 or 90-day period from the signing of the letter of intent to the closing. If they see that, then the purchaser will not be shy about coming back and talking about purchase price and payment terms, and probably a purchase price reduction. Okay. The last thing you want as a seller is to be someone, and this has happened occasionally, who comes and says, Ian, I need this deal to close now. You know, I went from being willing to sell my company to needing to sell it because, you know what? Last 6 months, we've been distracted by this process, this entire process that can take 6 to 12 months. I haven't been able to devote the attention I need. And guess what? It's impacted the business. Well, you never want to be a seller that needs to sell. You want to be a seller that has chosen to sell. Don't neglect the business. Business comes first. All right. Well, there's 5 points about sellers, sort of observations. What about purchasers? What do I see for purchasers? Well, the points I'm going to set up for purchasers, they apply mostly to the individual purchaser more than a private equity group. I think that's probably applicable for most of the people that are here to talk about, you know, buying a business yourself as opposed to being part of a group that's investing money you've either borrowed from other people or gotten invested from other people. But some of the points are pretty flexible and apply to any type of purchaser. Let's go for the first one. And it's the one that always comes up, financing. You can never be too prepared with your financing, and you can never start your financing process too early. You know, I always tell clients, when you've met with your account manager and they've said that you've got a deal, what that means to me is nothing. Okay. And many times I've had clients come to me and say, don't worry, I've got the financing. The bank's agreed. Okay. I say, well, that's good. Where's the commitment letter? Well, it's in process. Okay. Well, then what that means is the bank hasn't agreed to anything. All right. So financing takes time. It takes time to actually get commitment letters issued. Sometimes the commitment letters you were promised are never issued or are issued with pretty material changes. So I always like to tell people, start as early as possible. Maybe you can't start until you've got a letter of intent because you're not sure what you're even trying to finance. Fair. But guess what? You've got that letter of intent. The very next day, it's time to see your bank or whoever your financing individual or institution is. Remember, it's always more complicated and always takes longer than anyone tells you it will. I like to tell people, start early. And the second one is, don't be afraid to have multiple options and pursue multiple options. First of all, you might end up taking the better bidder, whoever it may be. Worst case scenario, not a problem. But even better, what if you run into problems with one during the process? It's awfully nice to have a plan B. Next, understanding the people value for the purchaser. Purchasers, much like a seller likes to overestimate the value of their business, purchasers often overestimate their own value and ability to immediately step in and run a company. Because you're doing something you haven't done before. Even if you've run a different company, you haven't run this one. Don't underestimate the value of the people around you in this business, both the principal who is selling and leaving, and also their senior management. You're going to need to figure out how to maximize them, keep them engaged, and then have them incented for, at the very least, a significant transition period, because they probably will be irreplaceable to you. So that's number 2 on the list. Don't underestimate those people, and that means you have to figure out how to keep them engaged post-closing. Next, if you're a purchaser dealing with a seller, set reasonable expectations and then meet them. And what do I mean by that? I see so many letters of intent that come through, given to the seller, and it says, hey, we think we'll be able to close in 30 days. And I don't represent the purchaser, but I already know they won't be ready to close in 30 days. They probably won't be ready to close in 60 days. But they've said 30. And what does that do? Well, they've assured the seller to get them to sign on this letter of intent by promising them 30 days. Remember that trust is a two-way street. I mentioned repeatedly that the seller has to build trust with the purchaser. Well, the purchaser has to build trust with the seller. Many transactions involve obligations of the purchaser to pay money for years after closing, up to 5 years. So if you're the seller and the first thing you say is, Ian, they promised me this would be done in 30. So far, they're still doing due diligence, and we're at day 45. There is no way this thing is going to close before 90. And you know what? I just don't feel comfortable that they've been telling me the truth. Listen, it's the same problem as the seller had. People want to say things to get deals. But listen, don't overpromise and underdeliver, because later on it will attack the trust factor. Instead, set reasonable expectations, make commitments to a seller that you know you can keep, because when you keep them, when you meet those expectations, it reinforces the trust. And the trust will play a role, certainly in the post-closing time frame, but also even pre-closing, with the seller's faith in you as a purchaser for what you will do post-closing, including make payments. The next thing I would say is, if you're a purchaser, make sure you've planned properly for the post-closing period. Now, we talked about individuals, but the other part I'm talking about is financing. Many times in transactions, vendors will look to front load sales. They want to drive up revenue. They want to drive up profitability. They want to drive up their working capital, which usually is set as a target. And if they can have the working capital on closing be higher than that target, they get a purchase price adjustment. All of this means that they probably are doing things like cutting deals to collect receivables early, and they are booking sales early, and then trying to turn those receivables from those sales into cash early. Very common, therefore, that post-closing, there is a lull, because in effect, the seller has pirated, they've cannibalized sales that would have occurred in the month or two after closing. They have cannibalized those and taken them into the earlier period. So what does that mean? It means, purchaser, that you don't just need enough money to close the transaction. You need to make sure you have enough money to be able to run this, even if it's operating below expectations, for a period of time post-closing. And that period of time is probably at least 3 months, and probably more likely 6. So make sure that you have, if you're a purchaser, that you have planned to deal with that accordingly. You don't want to be in a position where all you have is enough money to close, and then post-closing you realize that you need to put money in to operate, at least for a time period, and you don't have enough money to do that. Next, and my last point for purchasers, communication. And around the office, I always get in trouble because I tell my partners the same thing. I say, listen, don't send these people an email. Don't send that client an email. Call them. And many of my partners are younger than me, and they hate that. Calls can be awkward. Calls are a pain in the butt. Much rather email them. And sometimes, not often, but sometimes the response that comes back afterwards is, you know what, Ian, you're right. I should have called them. I got a very bad response to that email. And that's very common in this type of relationship too, between a seller and a purchaser. If you are the purchaser and you are going to be passing on bad news, and the bad news might be, you know what, we've given some thought to some of the things we found in due diligence. As a result, we're going to have to reduce the purchase price. or we're gonna have to increase the holdback or create a new holdback that we're gonna sit on for 90 days until we see whether or not that tax assessment actually ends up in there being more money paid, or any of these types of things. Bad news on the transaction. Don't let your lawyer deliver that bad news. I'm a guy that's delivered bad news before and received it on behalf of clients. Either way, don't let your lawyer do it, because it will be taken badly. If you've got bad news, the best thing to do is to call up the seller personally or go and meet them. Either way, face-to-face or on the phone. Face-to-face is better, phone's next best. And deliver that news in person first before it happens between counsel, because that makes them prepared. You can definitely present it in a better light than counsel would. And it's just responded to in a better fashion, even if they're unhappy. Always communicate. Listen, everyone likes to communicate good news personally. In transactions, always communicate bad news personally as well, and never have it occur first between the lawyers. It should always be first between the parties. So there you go. There's my sort of 5 points for each of sellers and purchasers and transactions, as well as a little discussion around transactions as well. I don't know if we have any questions, but if we do, Jasleen, be glad to try and deal with them. Oh, there's one from Brendan.
Hey, how's it going?
Pretty good. How are you doing?
Good, thanks. I missed the very start of it. What is your actual role, and what you bring to the table?
So I'm a business lawyer. I've been a business lawyer for just under 30 years, helping primarily privately owned businesses, and I do about half of what I do every year is help people buy and sell businesses. That would be a big chunk of what I do, and been doing that for the better part of 30 years for family-owned businesses, owner-operators, any type of privately owned business as opposed to public one. That's the type of thing I've been doing, helping people buy and sell businesses, and then helping them with business relationships.
Okay. Do you charge a flat rate fee, or how do you charge?
Depends on the project. For transactions, it's usually not a flat rate fee. It's usually more of a range, just depending on what happens within the transaction. It's easier to provide a more fixed range for sellers than it is for purchasers, because purchasers sometimes can morph. What I mean by that is the purchase transaction can be not just closing the transaction. It can be, hey, you know what, Ian, we have to do the financing. And sometimes it can be, actually, Ian, I need 2 financings to close. So, but you can usually provide a range or an estimate of what people can expect as far as cost goes.
Okay, last thing, will we get your contact info after this?
Absolutely. Jasleen, I can leave that in your capable hands. As far as passing on contact information, we will be sure to do it. Thank you very much for joining. I hope it was useful. And obviously, if you have any questions come up out of the presentation today, or if you have any sort of questions or concerns that you'd like to have a chat about, please feel free to reach out. I think my contact information is now in the chat, and glad to have an email or a conversation, see what we can do to answer your question or to help.